World leaders, panic. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, China just declared an emergency, and this is something that we've warned was going to happen because what it indicates is that China's economy is now in far worse shape than we thought. And this has global leaders on edge as central bankers now begin to cut rates in an attempt to engineer the impossible, because the fear is that what's happening in China will soon spread to every major industrialized economy throughout the world. I'll show you what China just did, and more importantly, why it won't work. Plus, we have a sponsor for today's show. We'd like to welcome La Rosa Holdings to the show. You can find them on the NASDAQ under the symbol LRHC, and they're disrupting the real estate agent commission model. And while other agencies are struggling since the DOJ settlement with the National Association of Realtors, what La Rosa Holdings is seeing is a flood of new agents, as they're the only publicly traded company with a 100% commission model. I'm going to show you why I think this could be a huge win for your portfolio. Check out the description below or the pinned comment, and stay tuned to the end of the show for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: as China unleashes stimulus package to revive the economy and, more importantly, the stock market. And this is something we've been warning was going to happen, because every attempt Beijing has made to turn around their economy hasn't worked. And then what happened is they got fixated on their currency because the yuan continued to crash. And we said the Fed would need to cut rates here and in a material way to help these other countries try to turn around their problems, because they desperately need to cut rates. But what we found out is rate cuts didn't work for China, as they now unleash a massive amount of stimulus. The problem is, as you're about to see, it's not going to work, and this is an issue that every major economy is soon to face. The People's Bank of China governor cut a key short-term interest rate and announced plans to reduce the amount of money banks must hold in reserve to the lowest level since at least 2018. And this is a dangerous move. When we start to hear about banks having their reserve ratio cut, what this means is they need to keep less money in-house and they can lend out more money. That's what the central bankers want here, is to get money out of the banks and into the economy. The problem is, if it doesn't work and you continue to see a rise in delinquency and defaults, well, we already know the problem with the Chinese banking system is they're massively over leveraged in the real estate sector, and this is putting their banks on the verge of outright failure. Look for the next banking crisis to be centered in China based on these moves, and that marked the first time reductions to both measures were revealed in the same day since at least 2015. And this is one of the reasons we go back to 2015, is the whole global economy was slowly sliding into recession, and China gets credit here for turning everything around because they did a massive amount of stimulus. But did it really actually work, or was it that the U.S. economy was starting to turn around? Because when we take a look at total income, which is informed average hourly earnings multiplied by average weekly hours, this for production and non-supervisory employees here in the U.S., what we saw is that there was this big decline coming out of 2012 as we nearly faced a double-dip recession, and then we see income growth rising at a nice rate. It slows down a little bit, and then it reaccelerates. Is this the China effect, or perhaps that the U.S. economy just got itself on solid footing and helped propel the world out of what was likely to be a recession? I think that's the case of what happened here. But right now, every global leader is turning their attention to China, because this time they desperately need it to work. No one really knows what happened in 2015, 2016, but everybody's hinging the turnaround of the global economy on China. And if it doesn't work, watch every major central bank, every major government is going to follow the same exact path. And those moves were followed by a slew of other announcements that fueled gains in China's beleaguered equity market, as the central bank chief also unveiled a package to shore up the nation's troubled property sector, including lowering borrowing costs as much as $5.3 trillion in mortgages and easing rules for second home purchases. Now, it's notable that they think people are going to run out and buy a second home because they're cutting interest rates a little bit. The reason people buy a second home is because they want one and they can afford one, and they're seeing the opportunity not only in their career path but their wage growth where they could actually afford it. The problem right now is not just in China, it's all over the world. There's a severe lack of confidence by consumers, and this is not going to lead to a big flurry of home purchases. For the nation's stocks, Pan said the central bank will provide at least 800 billion yuan of liquidity support, adding that officials are studying setting up a market stabilization fund because, again, it comes back to the markets, and what happens is when markets go down, people's net worth goes down. You talk about the wealth effect. This was coined by former central banker Alan Greenspan, who believed when people felt wealthier, they spent more money. And there's a lot of truth to that. Of course, China realizes that money is going to continue flowing out of their country. This is going to be a huge problem. They need to prop up the stock market. But as we'll talk about here in a little bit, it's not going to work, at least not the way, of course, Beijing hopes it will. Policymakers in Beijing have also been trying to revive the economy without resorting to the bazooka stimulus China deployed in previous downturns, which we said they would have absolutely no choice to do. Because think about it. China has a huge population. They could generate enough domestic demand. The problem is they don't, and they are the world's largest exporter, so they look to the global economy. And what do we see happening in other parts? In Japan, in Europe, in the United Kingdom, in the US, we see slowdowns in every possible way. Of course, that is dangerous for China, who's dependent on the rest of the world. They seem unable to make that transition, which is why we knew they'd have to do the bazooka stimulus. And another reason why we don't think it's going to work, as piecemeal efforts have been completely ineffective. We've been mentioning that on our show each and every time they've done one. Said it's not going to happen. And growth recently slowed to its worst pace in 5 quarters, a deterioration that's testing the leadership's tolerance for missing its high-profile annual target for the second time in 3 years. What is really causing havoc is they are aware that if the economy hits a recession, and it's highly likely that China will, and based on what they're doing with the banks, they could see an all-out financial crisis. The problem is there, people tend to revolt, and that means the leadership could be seeing a change in the years to come. They don't want that, but that's why that you're seeing them throwing everything at this. The problem is, without the global economy rebounding, it's just not going to work. The Federal Reserve's bigger than expected 0.5 percentage point slash is giving central banks across Asia more room to move. Now, if you think about what the motivation for the Fed was it that stocks were at all-time highs here in the U.S.? That wasn't it. Was the U.S. economy in that dangerous of a shape? Well, many people say no, but perhaps it was the global economy that the Fed finally realized that they needed to cut rates by 50 basis points to give other central bankers the margin to cut, out of the fear that if those other central banks cut their rates, that it means their currency would plummet. The Fed may have done a favor for everyone else. But making money cheaper won't lift the economy if Chinese consumers don't want to spend, because layoffs are looming amid sliding corporate profits and property prices are still falling. And that is a big issue. We're going to talk about what just happened here in the U.S. today, why we're seeing the same shift in U.S. consumer habits, why we're seeing this in, of course, Europe. We'll talk about them too. But there's the issue. You can stimulate all you want, but if consumers lack confidence in the economy, if they lack confidence in what the government is doing, they're not going to spend, meaning it becomes highly ineffective. That's the issue here. And new home prices clocked their biggest decline last month from the previous period since 2014. And this is the dangerous game of when you start to use stimulus over and over again, people start to expect it, but it's not just the expectations. There is a point where it doesn't work. And that is, again, the biggest risk that China faces and that other central bankers and world leaders are watching right now, because if it doesn't work in China, it's probably not going to work anywhere else. But when we talk about, of course, decreasing the federal funds rate in hopes to spur consumptions, there's no doubt the Fed did this in the hopes that U.S. consumers would get out and spend. That would help turn China's economy around. But when we look at advanced retail sales that is inflation adjusted, or real retail sales in red, against the federal funds rate, what we find is there's really not much of a relationship here. We can see that there was a slowdown in retail sales. The Fed cut rates. Did that really help retail sales? Maybe it did. Maybe it didn't. We can see here in 1998, the Fed starts to cut rates, but retail sales were already headed higher. But check this out. Heading the dot-com bubble, real retail sales were in decline, then contraction, and a Fed rate cut really didn't do anything. In fact, they had to make many rate cuts before there was any effect. You see the same thing happen in the global financial crisis. And while the Fed was cutting rates into the pandemic before we even knew about the pandemic, we were already seeing a turnaround in real retail sales. The problem we face now as they've been negative for an extended period of time, something we haven't seen before in history. The real question is, will rate cuts work here? Will it turn around the U.S. economy? Will it turn around the Chinese economy? I don't think it does, but I'd love to know what you think. Weigh in the comments below. And while you're there, check out La Rosa Holdings on the NASDAQ on the symbol LRHC. Let's take a look, because what was really driving the economy, what really drives spending, is confidence in the economy and an increase in incomes. As we continue to look at real retail sales, I've now moved that to blue against total income growth in form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And now as we go back and look at the U.S. data, it starts to make more sense. The slowdown in the mid-90s, well, that had everything to do with a slowdown in incomes. The same thing going into the dot-com bubble and the global financial crisis. How about what was almost that recession in 2015, 2016? Well, what do we see? Of course, a little bit of a decline in earnings growth, but retail sales, that was really what held up. Consumers continued to spend, but how about now? We're seeing income growth continue to slide. We're not seeing it transmit into real retail sales at all. The fact of the matter is, will a 50 basis point cut do anything? Does anybody even know what it actually means to the household budget? The answer is they don't, because it doesn't have any effect. That's the problem. And now we turn to Chinese stock traders who worry policy fuel gains may be short-lived, and this is all about running in and buying into the rumor, and then eventually is going to be selling the news, because the issue is going to come back is, will the stimulus work? If it doesn't work, then what you have is a bunch of people chasing what is now a gap up, overvalued move in Chinese stocks. Market participants would like to see more, perhaps other moves to boost consumption, and there's the key point. If you don't have consumption, you're not going to get a sustainable move higher in equity prices, and the general consensus seemed to be that those would not be forthcoming until after the U.S. elections. Now, this is really interesting to me, because I hear this all the time in the surveys. You read about it, and what it says is, well, we think demand is coming back after the election. The companies and people are putting off spending because of the election. Yet there's not one person I've talked to that said, hey, you know what? I was going to buy a house, but because of elections, I'm not. Or I needed a car, but I thought I'd wait till after the elections because I'm just not sure. So I don't buy into that narrative. Do you? Make a comment below. What do you think? Is the election holding off consumption, or will it not matter at all? I don't think it matters. That's my opinion. As Hong Kong stocks rose, but we'll have to see if those gains can hold. And that is the key point. Will they hold? That's only if the stimulus works. I don't see it happening, because I do see short-term positive market reaction as there's real liquidity impact and potential buying momentum to support Chinese equities. Of course, that's what happens when government comes in and says it's effectively going to prop up the market. You see people buying, taking a very quick swing at the market. However, the fundamental deflationary pressures, this is key. This is the economic data, the real data that shows demand is declining and there's just too much production. And that's what a lot of people don't realize. We had this big surge in demand at a time when production went down during the pandemic because we closed down all the factories. Now, without all the stimulus, we see demand going down, production going up, way too much capacity. That is deflationary pressures, and the property down cycle is going to remain intact because China's just got too many homes and people aren't going to want to go out and buy them, which will continue to weigh on consumption and hence economic growth. And as we talk more about what's going on in the Chinese real estate market, I want you to understand that this is going to happen here in the U.S. Just in a different way, but I want you to keep in mind why central bankers are going to cut rates, why eventually the Fed's going to be back at zero, and try to figure out a way to take rates at even new lows. It's going to happen for the same reasons you're seeing here in China, as China unveils the biggest package yet to boost its property market, as currently existing mortgages carry an average interest rate of about 4%, compared with 3.2% on newly issued loans. Now think about that here in the U.S. How many people have a really low interest rate mortgage that they got during the pandemic, and where are rates now? Now keep that in mind, because look at this. The move will ease mortgage burdens for an estimated 150 million people, cutting their annual interest expenses by about 150 billion yuan. And while China has pushed average mortgage costs to a record low this year, most households haven't benefited because banks won't reprice existing loans until next year. You're going to see the same thing happen, not just here in the U.S., but every major central banker is going to eventually cut rates. They're going to drive them to new all-time lows because as the global economy hits a recession and consumption continues to fall, there's only going to be one answer, and that is lower borrowing costs to free up cash flow and hope that people will spend. There's a reason why we continue to see perpetually lower and lower interest rates. But now let's turn to Germany, and we're going to take a look at the U.S. I'm going to show you why China's stimulus isn't going to work because they're so reliant on the global economy that there's no signs that anything anywhere else is getting better. As German business confidence dips in the latest recession warning, we've been flagging this, we've been telling you that the German manufacturing sector is in a recession, and where the manufacturing sector goes, remember, services sector follows. Everyone says this time's different. Well, history has a certain thing that says, and that is it will come true. The key weakness is really manufacturing, which is so important. We see this weakness across the board, really, machinery, chemical industry, electrical equipment, and the car industry. Companies are telling us we're lacking orders. This is a big problem. Again, we went from not enough capacity now to too much capacity. There isn't demand to meet all the production around the world, a big decline in new orders. And on top of that, we have weakness now showing up in the service sector, just like I said. And when you lack new orders, what happens? You clean out your backlogs. When your backlogs are gone, you start to laugh. So you think about people in the Eurozone. Are they going to start consuming in a big way to help support China's economy and the turnaround? Unlikely. But what about U.S. consumers? Remember, the Fed says the labor market's strong and robust, that the U.S. economy can pull through this. But based on what we just saw from the conference board today, well, it doesn't look like that's the case at all. As U.S. consumer confidence fell in September, as confidence weakened as consumers worry about, well, their jobs. And consumer confidence dropped in September to near the bottom of the narrow range that has prevailed over the past 2 years. As September's decline was the largest since August 2021, and all 5 components of the index deteriorated. Consumers' assessments of current business conditions turned negative, while views of the labor market situation softened further. Consumers were also more pessimistic about future labor market conditions and less positive about future business conditions and future income. In fact, the share of consumers expecting higher interest rates over the next 12 months dropped for the 4th month in a row, despite the fact that they don't believe the Fed's going to keep cutting here, because the Fed told them they weren't. But don't worry, we know what the Fed's really going to do. But here's a real key is against this backdrop, consumer buying plans for big ticket appliances were mixed, and plans to buy a smartphone or laptop in the next 6 months eased. And on a 6-month moving average, purchasing plans for homes and new cars, while improved slightly, still remain at depressed levels. And when asked about plans to buy more goods or services over the next 6 months, consumers showed a slightly greater preferences for purchasing goods, and that's already at a very weak rate. And that's going to change because even though they're saying they're thinking about buying things, the bottom line is when you lose confidence in your job and your ability to generate income, there's one thing you do, you cut spending. That's exactly what the University of Michigan Consumer Sentiment Survey, here shown in red, says against real retail sales. When confidence goes down, sales goes down. But how about this? Confidence has been rising, and yet it hasn't transmitted into real retail sales. It's only a matter of time now before we see those layoffs hit, and then we see the U.S. economy follow the same path as China. But let's talk about our sponsor for today's show, La Rosa Holdings. You can find them on the NASDAQ under symbol LRHC. I'm going to show you why I think this could be a huge win for your portfolio. All the information you need in the description below and the pinned comment. Let's check out what's going on because they are making waves in the real estate industry as they're the only publicly traded company with a 100% commission model. And this is something now since the DOJ settlement with the National Association of Realtors is attracting agents in a big way. And they didn't invent the 100% commission model. They just disrupted it. And here you can see agents at La Rosa earn more. And at a time when agents are actually expecting their incomes to go down due to the DOJ settlement, they're turning to La Rosa and in a big way. And you can see this settlement created major opportunities and huge benefits for La Rosa as they are strategically positioned to be the big winner coming out of that settlement. And here you can see some of the evidence as they reported a 154% year-over-year increase in revenue to $19.1 million for the second quarter of 2024. And here's some operational achievements and events that happened. They acquired 5 real estate brokerage franchises in the first 6 months of 2024 and an intent to acquire a Nona title agency known as Red Door Title, among other things. In fact, they've onboarded a record 400 plus agents since June, and more are coming. The record growth is due in part to the broad appeal of La Rosa's innovative multi-level revenue share commission plan, which is disrupting the real estate industry by increasing transparency as well as enabling agents to earn revenue immediately and, here's the best part, without restrictions. The plan combines immediate earning potential, a 5-level structure, and the flexibility of a 100% commission model. In addition, La Rosa Holdings is benefiting from the recent practice changes required for members of the NAR under the settlement agreement. These changes have propelled interest from agents looking for more lucrative and sustainable income streams. And they just announced their intent to acquire a real estate brokerage firm with over 950 agents and more than $19 million in revenue for 2023. We recently announced that we have onboarded over 400 agents since June 1st, this from the CEO, Joe La Rosa, demonstrating significant growth in interest in our platform. Our goal is to exceed 4,000 agents by year end, and we believe this acquisition, once consummated, can help us achieve that milestone. We expect that the addition of this brokerage firm and its extensive network will substantially boost our agent count and enhance our overall market presence. With our strategic focus on acquisitions and the rapid expansion of our agent base, we're projecting an annualized revenue run rate of $100 million by the end of 2024. This forecast reflects our commitment to scale our operations and capture a larger share of the market. And that is going to be a huge win. What we see for their stock could be a huge win for your investment and your portfolio. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before making any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.